2 weeks before, but due to festive season in the previous week, we had to postpone this webinar to today. And tomorrow we have CA Shuchi Agarwal. She will be deliberating on deemed exports. So once again, I welcome you all. I welcome Pruthi sir. Now over to you, Shivangi.
Thank you, Aditya. Am I audible enough?
Yeah, sure.
Okay.
Yeah,
Thank
sure.
you. Thank you, sir. Thank you, Aditya. And we welcome you, Pruthi, sir. And thank you for coming on the professional times and providing us your knowledge and your expertise on the topic export oriented units, EOUs, and export promotion capital goods, EPCGs. So, talking about Vimal sir, he is a director in one of the big fours, and he has over 15 years of experience in indirect tax advisory with specialization in customs and foreign trade matters. He regularly interacts with CBEC and DGFT, MOEF, and other ministries on various industry and trade matters. So we welcome you, sir. And yes, sir. And just giving us a short brief on this FTP series. It had 4 sessions. First session was done by CS Saurabh Jain, and second session was done by CA Pankaj Jain, and third session, which is being done by today by Sir Vimal Pruthi, and the fourth session would be done tomorrow by Shuchi Agarwal. And so, starting with the session, sir. So, over to you, sir. Vimal, sir.
Thank you, Shivangi. Thank you, Aditya, for giving the background, and thank you, Shivangi. So, and I thank all the participants for taking out their time for this educative session, wherein like we learn in the process. We'll discuss these two schemes, something you will learn. At the end, we have a question answer session. If you have questions, we'll be happy to answer your questions. For the flow of the seminar, we'll keep on with the material which we have prepared. And at the end of the session, whatever you have any issues, any issue you are facing, any questions, we'll be happy to answer those questions. I specifically at the outset want to thank team from Professional Times, because I know arranging the webcast, because we very frequently do webcast. I know how much effort it takes. It takes a lot of effort organizing infrastructure, the communication, etc. It takes a lot of time. So I thank the Professional Times team for that. So now we'll move on to our session. We'll cover two things: EOU scheme and EPCG scheme. These two things we'll cover in today's session. And at the end of the session, I'll show like how various schemes, what is the comparison of various schemes. Those are prevalent in the customs and international trade domain nowadays. But to start with, I'll start with giving a brief about the what is happening nowadays in customs and foreign trade domain, because that is I'll give a broader picture, and then I'll specifically come to Indian, what is happening in Indian custom and foreign trade domain, and then I'll move on to those specific two schemes, EPCG and EOU scheme. So predominantly, if we look in last couple of years, there have been a lot of trade dispute, and the protectionism has been prevailing. Like it started with Trump when he started. So in his session, she started with protectionism, and like a lot of benefits given to other countries were removed. So that is how it started, and then other countries also jumped into this war. So a lot of trade tensions are increasing in the last couple of years. Like if we see India, China, or US, China, and even India, US also for like last 6 months, there were a lot of increase on various product. India increased the duty, and US also the preferential benefit which it was giving to India, that it removed. So overall, in overall perspective, the protectionism is going on. So a lot of other countries are also jumping into this war. So it requires a lot of restructuring in the international supply chain, because like we have seen the goods coming from China, a lot of people were not able to clear for 15 days, 20 days when this detention on the border increased. So a lot of companies have also looked at that how they can modify their supply chain so that they can bring from other plants. So this trade dispute is increasing nowadays. The second important thing happening in the field of international trade is the FTA. So a lot of FTAs are happening. India has already signed approximately 20 FTA, and 15 FTAs are already in discussion. So this is from Indian perspective, the regional economic partnership agreement, which our Prime Minister decided that India will not go ahead with this. So that was one of the big regional agreement. Other lot of other bilateral agreements are also happening. EU Asian FTA, like with few of the countries like Thailand and Singapore. Already the wish list has been finalized, but few other countries it's in discussion. Recently, 3 4 days back, Japan and UK FTA, two larger economies of the world, they have entered into a FTA. So a lot of the use of FTA is increasing. So that is one aspect, and it is expected like 30% of the international trade will be using is using around like FTAs. So in India also, in the international trade domain, one recent development has happened, and that is introduction of Karotar. That is the Custom Administration of Rules of Origin regulations. Those have been issued, and if you talk to any client who is importing goods, he is facing the heat of these provisions, because now custom authorities are asking. Earlier, they were only on the basis of certificate of origin. They were they were giving benefit. Now they are asking for greater details, and you would have heard in the news like it is taking 10 to 15 days. The clearance, which was earlier taking 2 to 3 days, now it is taking 10 to 15 days. So this is one another area in international trade domain which is happening. The third is Brexit. So UK left EU. They took a call that in Jan they will leave EU. So now that is in process. Brexit is in process, and so a lot of in international trade domain. This is also one of the aspect how one need to deal with UK. That is also one of the aspect which the MNCs are considering. UK is in the process of entering new FTAs, and a lot of curiosity among the MNC client is how they will deal when UK will go out of the EU. So EU and UK, how the international trade will happen, the custom and international trade will happen. That is also one of the aspects. One important area which typically like chartered accountants are not like privy to, or they use very less, is export control regime. So this is also one of the area which is catching traction nowadays a lot. China has issued its export control law. India already has what we call as SCOMED law, which is the export policy. So traditionally, India was not doing a lot of export of technology, or anything which can be used for dual purpose, means civil and defense purpose. But nowadays, India also is becoming a subsidiary and research unit for a lot of companies. Those are in the business of manufacturing defense equipment. So India also has India become a part of Wassenaar arrangement. So India also has increased the scope of its export promotion law, and a lot of MNCs are like asking about these laws also. And everyone want to be self-dependent in defense stream. So everyone is like increasing and making and strengthening their export control law. So these are few things happening, and definitely one is the non-tariff barrier. So a lot of countries being member of WTO, they are not allowed, they can't increase the custom duty. So they are finding for other ways how they can stop the import of other products, like India is doing. India is recently on toy industry. India has introduced Bureau of India BIS registration. The The same way, day before yesterday, India introduced provisions for shoes. Like for shoes, shoe also the BIS registration is required. So these non-tariff measures, a lot of other countries are also taking, and India is also taking, so that the self-dependent or Atmanirbhar Bharat scheme, so that can be promoted. So this is broadly happening in international trade domain. So I'll also mention, because when we'll come to these schemes, EPCG scheme and EOU scheme, these are part and parcel of, because these independently can't work. These are policies, these have to work with the custom. So what is happening in custom? So in custom, also a lot of measures, like in last couple of years, I have seen in last 1 decade, whatever the digitalization and trade facilitation they took, more than that in couple of years they have taken. So that most of the things are flowing from the trade facilitation agreement, which India ratified in 2016. And in terms of that, there are 100 trade facilitation program, around 100 trade facilitation program. India has made its trade facilitation program 2016 to 20. So in terms of that, lot of changes in customs and international trade domain and foreign trade policy also are coming, because this trade facilitation agreement, lot of things are to be done by DGFT, lot of things are to be done by CBEC, lot of things are to be done by Port Ministry. So the overall objective is that the ease of doing business ranking and trading across border, that should, the rating of India should be improved. So with that objective, the AEO program was again launched in 2016. So India in 2018, India started the decentralized advance ruling, because in India, any litigation, if there is any issue in relation to classification, valuation, once the litigation start, it takes up to a decade to settle. And the existing central advance ruling authority, which is a advance ruling authority for income tax, also they are taking like years. From last 1.5 years in customs, at least they have not decided any matters. So in 2018, the decentralized advance ruling was introduced. And recently, a couple of days back, now the advance ruling authority for Delhi and Mumbai have been notified. The rules, forms, and the names of officer, those are yet to come. We expect that will come from 1st of December. So, India also is taking a lot of stuff. And recently, under the Turant Custom Initiative, India has started the faceless assessment. Similar to income tax, in customs also now the faceless assessment has been started from 1st of October. All India, all commissionerate have become now faceless. So there are faceless. Faceless customs groups. Those are working. So anyone files a bill of entry anywhere, the assessment will be done by the faceless assessment groups. Those are sitting in at various ports. So there have been like 12 faceless assessment groups have been made all across India. So they are doing the assessment. So overall, the message is like lot of digitalization, lot of trade facilitation measures is going on. Like the teething issues in relation to faceless assessment are coming, but in the coming days, those will also be resolved. So I just gave you a broad perspective of global perspective of India in customs and international trade domain, and then what is happening in India. So now I'll move to our schemes. So prior to that, I'll give a perspective which all schemes are there under the foreign trade policy and what is the fate of that. Uh, so we have various schemes, but in 2014, as per US, as per their calculation, India achieved that per capita income of India was more than $1,000, and therefore US was of the view that now India can't have export promotion schemes. Those are in the form of subsidies. So they filed an appeal against India in WTO for various schemes, which included Advanced Authorization Scheme, SEZ scheme, even the two schemes which we are going to discuss, the EPCG scheme and Export Oriented Undertaking Scheme, MEIS scheme. So all these schemes, there is a ruling against India that yes, these schemes are in the nature of subsidy, and therefore India should remove these schemes, or India should close these schemes. But like any sovereign country, they have their own suit. Will India filed a appeal against that matter, and that will take its own time in taking the decision. So in the meantime, India is continuing with these schemes, and the current policy of FTP, foreign trade policy of 1520, that was increased up to 31st March 2021, and accordingly these schemes were also extended. But Indian government also knows that these schemes they can't live long with these schemes, so they are coming with new schemes. They have introduced one new scheme, custom mounted warehouse manufacturing, which they are promoting a lot, and the other schemes are expected to go. Even we are working with government, like how the existing export oriented unit, they can move to custom mounted warehouse scheme. So we are helping government in explaining them what are the changes to be made in foreign trade policy, in custom notification, etc. So that we have suggested, and we have helped the Central Board of Indirect Taxes and Custom to make those changes, so that these schemes, the units working under the EOU scheme, they can be moved to the new schemes. So so it's there is a snapshot which you can see on the screen, like duty drawback scheme. This is a fine scheme. This is not in the nature of subsidy. So this has a validity. But the other schemes, advanced authorization scheme, SEZ scheme, export promotion scheme, export oriented unit EOU scheme, or MEIS scheme, these are not having a long future. There is a ruling against India for these schemes. So one new scheme which India is in the process of issuing, that is a refund of state levies for textile. Already it is there. Similar to that, ROSCTL, refund of state and central levies. One scheme for other than textile, that is also India is in the process, and Indian government is collating data from through various export oriented units, and we are helping in that also to government. For Engineering Export Promotion Council, we are collating data for various SKU, various tariff line items. So as and when that data will be prepared, the non-salvatable taxes, like the taxes on electricity, taxes on petrol, any octroi, etc. So in lieu of those, India will grant a scheme which will replace the merchandise export incentive script scheme. So that scheme is also in the process. This scheme will be a valid scheme which will have a long future. Then the last one is the CBW scheme. Uh, as I mentioned, the custom mounted warehouse manufacturing, one director general in Bangalore, he is leading from the government side. So we are time and again doing a lot of webinar for this scheme, because Indian government want to promote this scheme. So in the past 2 months back, they clarified the doubt of industry regarding this scheme. 2 3 days back also, we have made a compendium of around 50 issues. Out of that, 3 4 issues they have again clarified regarding job work, so that this scheme can be promoted. And because industry has certain doubts, which I understand in the last in our series, last time we discussed about this scheme in detail, so I'll not go into the detail of this scheme. I'll just give a brief overview of this scheme. So how this scheme works? This scheme is one of the scheme which is taken, which is already in use in Europe. So under this scheme, one can have a unit. He can make that unit a custom bonded warehouse under Section 58, which is a private bonded warehouse, and they need to take a license for manufacture under Section 65. So they can import capital goods and raw material, both the goods without payment of any duty. So I'm just giving a brief background of this, because the two scheme which we are going to discuss, EPCG, that is also the objective of that scheme is importing capital goods without payment of duty. and the other scheme EOU, that is for capital goods as well as raw material. So this scheme, custom bonded warehouse manufacturing scheme, which in the coming decade we are going to see, we are going to discuss, we will be having a lot of webinar in the coming years on this scheme, because this will be the only scheme which will prevail. All other scheme will end, they have to end, because already ruling is against India. So India is using its power for deferring that scheme, but ultimately those will be closed. So in this scheme, one can have a unit, he can import capital goods or raw material without payment of duty, do the manufacturing and export. So nothing to be paid. So there is no taxes which will be levied on raw material or imports or capital goods. The goods are manufactured and exported. So if someone want to use the same facility and want to manufacture and supply to Indian domestic market, then that can also be done. In that, one need to pay the duties on the input. Like if someone is doing a manufacturing of mobile phone, he need to pay duty on keyboard and the hard disk drive, whatever is you going into the laptop. So inputs on the materials and on the finished product pay the GST. So this is one of the scheme, first time scheme. This is even better than SEZ. In India, SEZ has not become a big success. In other countries, it has become a success because when the goods are manufactured in SEZ and cleared in DTA, then one need to pay basic custom duty on the finished goods. That is why, like the same infrastructure of SEZ was not the intention of government, was not allowed to be used for domestic supply also. And therefore, if someone is having a 10,000 crore rupees, if someone is spending for a plant, then he will for sure want to manufacture from that plant for supply to India and outside India. But SEZ scheme, if you manufacture something and you clear in DTA, you need to pay basic custom duty on the finished goods. So that was de-incentivizing. So even to that extent, this scheme is better than even SEZ, because same infrastructure can be used for both purposes. There is no NFE requirement that 50% you need to export, 50% you need to import. You can, whatever you want to do, you can do that. Uh, so this scheme we have discussed in detail in the last series. So I'll move on to our specific topics, the export promotional capital goods scheme. Uh, so in EPCG scheme, as the name clarifies, export promotional capital goods scheme. So this scheme is only for import of capital goods. This is not for raw material, etc. So under this scheme, the objective of government was that India should also move on to manufacturing. This is a decade-old scheme. So India should move on to manufacturing, and capital goods can be imported without payment of duty. In the erstwhile scheme, there was a concessional rate of 5%. Then people were not interested. Then government took it to 3%, and now it is 0%. So anyone can import goods, capital goods, without payment of duty. So typically on capital goods, if we move through chapter 84 and 85, which covers the capital goods, typically there is 7.5% or 95% of capital goods basic custom duty of 7.5% is levied, and 18% GST is levied. So one can import without payment of basic custom duty or GST. So the ultimate benefit is actually the basic custom duty, because GST one can take Senvet credit or GST credit of the 18%. So that is not a actual saving. That is only a cash flow saving if someone uses the basic custom this EPCG scheme. But BCD is a actual benefit which goes into the pocket of company, which is a saving for the company. So with this objective, this scheme was introduced. One can import capital goods without payment of duty. Indian government doesn't want that only import is happening for under this scheme. So there are a lot of companies like BHEL, those manufacture capital goods also. So Indian government said, okay, if someone want to avail benefit in domestic supplies, without payment of duty, without payment of GST, then he can use this scheme also. So one can domestically, indigenously also procure the capital goods under this scheme. So who can procure these schemes? Anyone who is a manufacturer or a service provider, he can import capital goods under this scheme, or a manufacturer exporter tied to supporting manufacturer, like for mobile phone manufacturing, like if someone is using, Apple is using Foxconn, so even Apple want to use these capital goods in the premises of Foxconn, then that can also be done. Supporting manufacturer, if is doing the manufacturing and the objective is export after manufacture, then this scheme can also be used. uh, what is the obligation under this scheme? Anyone who is importing goods under this scheme need to export goods, and he need to export goods 6 times of the duty saved. For example, if someone is importing $100 of capital goods, and he will save say $30 of duty, then he need to export 30 into 6, $180 goods in the coming 6 years. So it looks very easy. Okay, $30 I am saving, so $180 I have to do. So superficially it looks good, but when someone goes into the detail, this one need to do over and above the average which he is doing. So if someone is already exporting like $1,000 of goods, that one need to keep doing. So this will be over and above. This is the additional obligation which one need to make. And so one can import, like after taking, we'll go into the detail how to take this scheme, or how to get the authorization for this scheme in the coming slides. But after taking, one can import within a period of 18 months. He can import the goods using this authorization. So this authorization is given by Director General of Foreign Trade. Earlier it was everything was physical, now everything is online. So this authorization need to be produced before the custom authorities. At the time of import, they will debit the value of imported goods, and on that basis they will give benefit of concessional rate of 0%. So in the application itself, one need to mention, because the authorization need to be registered. So one need to like tell which port of import he want to do. Like from major import, if someone want to import from New Delhi, he need to mention that. If there is a requirement, something like original plan was something, everything will come from Delhi, but something need to come from the Mumbai port, then there are systems. One can take a letter and a letter of debit, and on the basis of that letter, goods can be cleared from Mumbai port also. So over the year, government found that lot of people are not able to fulfill the scheme, and lot of notices were issued first by DGFT that you are not fulfilling the export obligation. Because as I mentioned, people are not able to estimate their export, what is the exact amount of export, and sometimes a lot of like miscalculation happen. Sometimes people are they even not consider the average export obligation. So due to that, a lot of people were not able to fulfill the export obligation. So uh, a few years back, government issued a new scheme which is called the new type of the scheme, same export promotion capital goods scheme. So under this scheme, government said, okay, earlier we are saying that you take a authorization from us, and and you import capital goods without payment of duty. So under this scheme, you come to us, take a authorization from us, but pay the duty upfront. And later on, when you fulfill your export obligation, whatever you are able to fulfill, in that proportion, you take benefit from us. So as I gave the example, like if someone has to import $100 of goods, he will save $30 of duty. So instead of upfront importing goods without payment of $30, one can pay $30, and after 3 year or 6 year, whenever he is able to fulfill the export obligation, like 180 he was supposed to do, but ultimately he found like he's not able to do, and after 6 years he's only able to do a $90 additional export. Then he can go to government and he can get $15 scripts. Those scripts are equivalent to cash he can use for further import. So the benefit was, if someone is upfront not paying the duty, then at a later point in time, if he is not able to fulfill the export obligation, then he need to pay differential duty, he need to pay 15% interest. Customs will even allege that you never intended to complete this, therefore there was a fraud, misrepresentation, and you pay penalties, etc. also. So to overcome that, this scheme was introduced. This was again beneficial for the industry. So coverage of capital goods, what one can import. So anything which is required for pre-production, production, or post-production, like packing, etc. So those goods can be imported under these schemes. The definition is very wide under capital goods scheme. So it includes plant, machinery, accessory required for manufacture directly or indirectly, or for rendering services. So there is a wider definition given in Chapter 9 of Foreign Trade Policy. So it includes the capital goods either in CKD or SKD form, computers or software. Those are part of capital goods. There have been case law. There have been famous case law that if someone want to import computers for office use, whether those are capital goods or not. So there is a tribunal ruling which says that yes, computer are also capital goods, so one can import under EPCG scheme. But there are certain circulars issued wherein they have mentioned like you can't import. Uh, so one can import molds, dyes, etc. also under this scheme. So if someone want to use EPCG scheme along with project import scheme, then that is also allowed. So under project import scheme, like if someone is making a new plant, new industrial plant, setting a plant for manufacture of cars, etc., then there is one more scheme which is called project import scheme. One can use that scheme, and under project import scheme, the basic custom duty comes to a concessional rate of 5%, and under EPCG concessional rate comes to 0%. So if someone want to use both the schemes, that is also allowed. The benefit will only be the export obligation. Normally it will be 7.5% plus GST versus zero. So whatever is the duty saved amount, that is how it will be calculated. If someone is taking project import also, then the duty benefit calculation, duty saved calculation will be 5 minus 0. So 5 plus GST, 6 time of 5 plus GST. So even because ultimately the export obligation becomes a huge thing. So people use, if someone is installing a new plant, then people use this scheme for both the schemes simultaneously also. So typical difference, which I have already explained, but under both the schemes is uh, the benefit under both the scheme is one can import for pre-production, production, or post-production at zero custom duty rate. But when importer is not sure of fulfilling the export obligation, he can go in post-export EPCG scheme. The export obligation under the normal EPCG scheme is 6 time of duty saved. In case of domestic procurement, if you are taking capital goods from BHEL, etc., then it is 4.5 times. In case of post-export EPCG scheme, because like people are in normal EPCG scheme, the money goes from the pocket of government the first day itself because one will not pay duty. In the second scheme, the money will go from out of pocket after 6 years, or one can go after 3 years also. In parts also one can get. So they want to give benefit, the proportionate benefit. They did some calculation and they said, okay, you need to now fulfill 85% of normal. So that benefit, the interest part also in a way has been reimbursed by reducing the export obligation. So in normal scheme, one need not to pay duty. Under post-export EPCG scheme, there will be a cash flow which one need to pay, and later point in time he can get the money back. Uh, non-fulfillment of EO, which in many cases it happens. So in the present case, one need to pay duty, interest, and even penalties proposed. While we take argument that in the notification itself, it is mentioned that in case of non-fulfillment of export obligation, one can pay duty plus interest. So there are tribunal ruling which say that when there is non-fulfillment of export obligation, then paying duty and interest is a compliance of the condition itself. Therefore, the penalty, etc., is not required to be paid. And tribunal have accepted that argument. But department want to show that yes, there was a intention of not fulfilling the export obligation, and you just want to take this scheme without intention. So, so to avoid all these interest and penalty thing, if someone is not sure that he will be able to fulfill the export obligation, then one should go for post-export EPCG scheme. So export obligation is the one of the main requirement under this scheme. So the export obligation can be, so there are two types of export obligation one need to fulfill. One is the average export obligation, and the other is the specific export obligation. The average export obligation is the arithmetic mean of 3 years. If one is applying in year one, year four, then first, second, and third year, whatever export he is doing in those 3 years, the arithmetic mean of that will be considered as the average annual export obligation. So that much one need to do every year. And after that, whatever we have discussed, the export obligation, 6 time of duty saved, that need to be done. So every year in the shipping bill, one will start mentioning the its shipping bill, its EPCG license number in each of the export. He will keep mentioning. So and he will keep calculating. One need to keep Excel sheet or whatever record they want to make. So they need to maintain record that year on year, like companies file thousands of shipping bill. So in those, one need to take calculation that yes, now I have fulfilled the average, and after that, one need to start. One need to start looking at the specific export obligation. So one important thing comes here is a lot of time the average export obligation is wrongly fixed. So if I give an example, so for few of our clients, we were able to close their licenses, like someone took 60, 70 licenses by just making the average corrected. So there are provisions in the FTP that if someone is having, so people take continuous basis, people keep taking EPCG license, the expansion keep happening, and for that people, the companies keep taking license. So if for example in year one there was $100 export, year two $200, year three $300, so average will come $200. But after that, when he goes for second license, and till taking the second license, the first license is going on, and one company is fulfilling the additional export obligation under that license, then the provision says that whatever has been the average, so it is written in some complicated words, but the message is the old license average export obligation that will continue for license 2, 3, 4, etc. Also, if one is continuous basis taking license. But sometime while filing the application, if someone mentions the actual average of the turnover of last 3 years, the export turnover, then in the license they will fix the new average export obligation for license 2. So one need to be careful in filing the application also, and one can take result of these specific provisions. So this export obligation can be fulfilled directly from the plant, or because it is allowed for supporting manufacturers, so goods can be directly exported from the supporting manufacturer also. But one need to keep fulfill first average need to be fulfilled. Like if in year one is not able to fulfill average, Then in year two, first the average will be fulfilled, and then additional export obligation will be fulfilled. So certain facilities have also been given, like if someone is doing a deemed export, like supplying to a advanced authorization holder or DFA holder, uh, supply to those schemes also can be covered for fulfillment of export obligation. Uh, Along with that, if someone is supplying goods under ITA bound agreement, so so information technology is a global agreement in terms of which there is zero duty on these products when these are imported into India. Couple of years back, even mobile phone was one of these items, but ultimately Indian government took a call that the new kind of video phones are not covered under this, and therefore they introduce a 20% duty. So if someone is manufacturing ITA bound item and supplying to in domestic tariff area for foreign exchange, then those can also be considered as if for fulfillment of export obligation under EPCG scheme. So service providers, if someone is taking EPCG license, if someone is providing a back office service, for that he is taking infrastructure. So by their services which they are providing to their overseas customer, the payment for that can be considered. Or if someone is getting some royalty, etc., that can also be used for fulfillment of export obligation under EPCG scheme. R&D, if someone is doing, or royalty. So all these, so the objective is that foreign exchange should come into India by use of those capital asset. If the correlation is there, that can be used for fulfillment of export obligation. So there are a few other things, because this is one of the area where a lot of litigations happens with DGFT as well as with CBEC, because license is given by DGFT and the import is made from customs. So if any default happens, then both the authorities will come into the play. DGFT will issue their notice that you have not fulfilled the export obligation. CBC will issue their show cause notice that you have wrongly taken the benefit, therefore pay duty back to us. So in those instances, there are Supreme Court ruling which say that the first jurisdiction is with Director General of Foreign Trade. They will decide whether the export obligation have been fulfilled or not. After that, custom can come into the action. But still, practical challenges we see both. If any default is made, the action from both the authorities is triggered. So there is also a requirement that 50% of the export obligation is fulfilled in first 4 years, and balance 50% is fulfilled in fifth and sixth year. So over the years, we have seen that like no one was checking. Typically, like 99.9% of the companies, they were fulfilling export obligation and going for getting the closure certificate, which we call EODC, export obligation discharge certificate, after sixth year. But 3 4 year back, CAG did the review of CBIC, the Controller and Auditor General of India, and they issued a report that what is this happening when there is a law that you have to see if someone is not fulfilling export obligation 50% in fourth year, then you issue notices. So now they have started issuing notices for that also, if someone is not completing the block export obligation. So for that also the notices have companies have started receiving. So there are provision if someone is not able to fulfill the block-wise export obligation, then one can pay some fees, and it can go to government 2% of the duty saved amount, whatever proportionate he is not able to fulfill, he can pay that, and he can get the extension that he will fulfill in the coming in the second block. So those provisions are there, but one need to pay 2% of duty saved. So this was a trade facilitation and a practical challenge which companies were facing. To overcome that, one provision was introduced that if there is a authorization, because if someone is making a plan, so typically this is either making of plant or making of or expansion of plant. then one never knows like how much capital goods will be required. So one broadly knows, but there could be some like spares are coming additional. So one is importing one machine. So with that one spare came, but he planned one spare part will come, but two spare part came. So in that situation, they were not able to manage. So to overcome that, the provision was introduced that up to 10%, if the limit is increasing by 10%, one need not to go to DGFT and get the license extended. Uh, so one need not to go there and get the license extended. But if it is more than 10%, then one need to go there and get the license amended, and accordingly the export obligation, etc., will also be increased. But if someone is like using less, he took a license from Director General of Foreign Trade for $100 of goods import, but he used only 50%. He imported only 50%. Then in that situation, the export obligation will also become 50%. So the application process is a simple process. Not much is there. So presently one need to file. So anyone, either the registered office, head office, or the manufacturing plant, wherever the RA is there, the regional authority who has the jurisdiction there, one can file the application. So there is one simple form wherein one need to tell what capital goods he is importing. One certificate from chartered engineer is required who will explain the manufacturing process and also mention how these capital goods are required for manufacture of the product which is intended to be exported, by which the export obligation will be fulfilled. So in ANF 5A, one need to file online application. While if someone reads the book, everywhere it says that you need to file a online application, but practically after filing the online application, one need to take a print, file the set with the regional authority, and file a set with the headquarter in Udyog Bhavan also. So that is how the practically the process will happen. So there will be a committee which will look, and they will grant license. So while there are provisions that the license should be given in 30 days, but if complete details are given, these license can be obtained like week 10 days also. So compliance, there are some compliance requirement also post obtaining the authorization. So one is one need to register the EPCG license with the custom port from where it is importing, and whenever the imports will come, this will be debited. All this is now automated. Even the DGFT server and the custom server are linked. So anything happening in custom server will be updated in DGFT server also. So there are some compliance requirement that one need to maintain proper records. Uh, One asset register is made in each of the company where the goods are imported under EPCG scheme. One unique marking, unique number is also assigned to the authorities, because these are actual user things one can't dispose of unless the export obligation have been fulfilled. So one need to maintain proper record, and the physical recognition of the asset should also be there. So there are some requirement that one need to submit every year, by 30th of April every year, what is the export obligation have been fulfilled. So that need to be submitted. So for obtaining EPCG scheme, as I was mentioning, one important document is this Nexus certificate, which is obtained from chartered engineer, similar to chartered engineer building is near to in Delhi, near to our ICI. So from that chartered engineer, one certificate is required to be obtained. While DGFT have their in-house officers, wherein they can also question whether this product is required or not. Typically they question also if someone, so whatever is minimum required for starting the plant, that only they grant. If someone want to import additional excess spare or something which is not a capital goods, then they can ask questions, and they may not allow those goods. So one another requirement after once the goods are so the process, if someone has obtained a license from DGFT, debited at the custom port, machinery has come. Once machinery reach at the plant, then one installation certificate is required to be obtained, and within a period of 6 months from the date of installation, that certificate need to be given to submitted with the DGFT authority. This is one of the area where 80% of the company, like after coming of the machinery, people forget and they don't do a compliance. When they go for EODC, this is one of the requirement due to which a lot of people are not able to obtain EODC. Even as a practice, people don't care for EODC, and few years back now the electronic system is there. Earlier, when the physical system was there, a lot of companies were not going for EODC also, and 6 months back, DGFT issued notices for around 1,500 EPCG licenses wherein the EODC was not obtained. So one need to, after installation, if it is a manufacturing concern, then from custom, if it is a service tax, if it is someone is a service entity, then from chartered engineer, a certificate of installation can be obtained, and that need to be submitted with the DGFT authorities. So post-export EPCG, which we discussed, in that the process will be similar, but there will be little variation. So the application which is filed with DGFT, that will remain the same. In 5A, one need to file the application. In 5A, in the start itself, it asks whether you are going for a normal EPCG scheme or you are going for a uh, post-export EPCG scheme. So that one need to tell. So in that, after obtaining the authorization, whenever someone is going for get the money, then one need to file ANF 5B, in which he will mention that how much export obligation he has fulfilled, and accordingly the scripts will be issued. So there are re-export provisions also. If some defect comes and one want to export the capital goods back, those provisions are also there. The value of the goods imported, or the duty debited, credited, or benefit taken, that can also be adjusted. So those practical provisions now, because this scheme is coming to end of its life, so this has been all those practical challenges have been taken care of and incorporated in the scheme over the period of time. So few miscellaneous aspects, uh, like realization of export proceeds. As I mentioned, the objective is to receive foreign exchange. So all money should come in foreign exchange. If one is supplying to SEZ, then from the foreign currency account of SEZ, if someone is manufacturing and supplying to SEZ, then the from the foreign currency account of SEZ also the proceeds can be received. So there are a lot of incentives for various kinds. Couple of we have mentioned, like if someone is a fast tracker, instead of 6 years, if someone is able to fulfill in a period of 3 years, then government says, okay, instead of 100%, you do only 75%. Same way for Northeast, there is the export obligation is only 25%. Same way for some of the green products, there is a concessional rate wherein again one need to 25% export obligation requirement is waived. So typically the period is 6 years, but time to time government keep looking at the industry, and if there is something big happening in the industry, like now the COVID has come, so they can increase the period to six from 6 years to 1 more year. Or if someone is not able to fulfill 5%, 10%, or 20% of export obligation, and he want to expand the period from 6 years to by 1 more year, then all those schemes, all those things are also, there are provisions that it can be accommodated on payment of a small fees, and the export obligation period can be extended. So one last requirement, like if someone has lived this scheme, then after using this scheme, one need to go to DGFT and obtain a export obligation discharge certificate. So earlier one need to like provide 2-3 box file of the shipping bills which he has exported over the period of 6 years, how he has fulfilled the average export obligation and additional export obligation. But now all everything is like digitalized. So whatever is submitted in when someone is exporting, at the time of exporting shipping bill, one need to submit the EPCG license number. So it automatically calculates, and on that basis, one can go to DGFT. He can submit form ANF 5B, and if everything is tallied, one has done the required export. Then export obligation discharge certificate is issued by the Director General of Foreign Trade, and then for import, when one has registered its EPCG license with the port of import, there also, if some bank guarantee has been filed or bond has been filed, that can be released. So when that is released, the scheme is like the complete benefit of the scheme is availed. So as I was earlier mentioning, there are provisions. If there is some defective goods coming, one can re-export the defective goods, and proportionate export obligation or duty saved amount that can be amended. If someone want to send for repair, then that is also allowed. And for repair, or if something enhancement is done, some additional amount is incurred by one person, then the duty saved amount for that repair cost will accordingly be increased, duty saved and export obligation. So all these practical aspects have been taken care of. So if some so one small piece, like if this EPCG scheme can be for a new plant, or if someone want to come from EOU scheme or SEZ scheme to a domestic tariff area, and he want to avail benefit of EPCG scheme, like this Korean mobile manufacturing unit in Noida, they were earlier EOU scheme. So they moved on to a domestic tariff area unit, then they use the EPCG scheme. So whatever capital goods are lying in the EOU or SEZ, those can be used, can be taken under the EPCG scheme, whatever is the depreciated value, those that value and whatever the applicable duty comes at the time of movement from SEZ or EOU to DTA, wherein one will take a permission from the development commissioner or SEZ development commissioner. And then under EPCG scheme, also the goods can be brought in the domestic tariff area, and whatever the he was using through EOU, he was exporting the obligation under. From SEZ, one must be exporting. From EOU, also one must be exporting. So the requirement under EPCG can be fulfilled. The export obligation can be fulfilled whatever one was using under the existing scheme. But one will come out from SEZ or EOU, because there are larger control in EPCG. You just need to fulfill your export obligation. It's in-house, and after completion, one can take the EODC. So there are clubbing process are also required. If one has taken more than one scheme, then more than one authorization, then there are provisions that one can club. So with this, I'll end the EPCG scheme, and I'll move to the other scheme, which is export oriented unit scheme. I'll just okay. So this scheme, EPCG, is covered under Chapter 5 of Foreign Trade Policy. This scheme is governed by Chapter 6 of Foreign Trade Policy. So if we see the flow of Foreign Trade Policy, Chapter 1 and 2 gives just about the basic concept. Chapter 2 gives general provisions regarding import and export. Chapter 3 gives schemes like MEIS, SEIS. Chapter 4 is for imports, which is Advanced Authorization Scheme. Chapter 5 is for capital goods, which is EPCG scheme. And then Chapter 6 is EOU scheme, which is a combination of input and capital goods. So under this scheme, one can import capital goods as well as raw material without payment of duty. Chapter 7, like now, earlier it was blank, now it is deemed export, and chapter 8 covers the definitions. So if one want to understand about this scheme, then one need to understand chapter 6 of FTP, chapter 6 of HBP, various forms, notification, custom notification 52 oblique 2003, which gives benefit of all these schemes. And that notification is a complete code in itself, and various circulars, etc., uh, issued by DGFT as well as customs. So again, the objective of this scheme also, I have mentioned earlier also, is to promote export, uh, get the foreign exchange. The principle is like only the goods, if goods are manufactured in India, those should be exported, not the taxes. So there will the objective is there should not be any tax on inputs or capital goods that should become part of the export outgoing product. So under this scheme also one can import uh, all product without payment of duty, the capital goods or input. So here also, while applying for this scheme, so there is, because this scheme is governed by DGFT, again by DGFT and the Ministry of Finance. So from Ministry of Commerce, the Development Commissioner are the authority who will give license for this scheme. One, after identifying the scheme, one will go to the Development Commissioner, like for Northern region, Delhi, Gurgaon, the Development Commissioner is in Noida. So sometimes the authority is given to SEZ Development Commissioner for granting EOU related stuff also, the approvals also. So one will file application in ANF 6A, wherein basically one will tell again his plan in the period of 5 years, what all one is going to import, the capital goods and input, and what he is going to export. So he need to demonstrate how he will earn foreign exchange by export, how much inflow of foreign exchange will happen as compared to the outflow of foreign exchange on import of inputs and capital goods. So one need to give his plan, and typically like they will give the approval in within 15 days. So after getting the approval, one need to like inform, file a undertaking, and he need to inform the custom authorities also. So typically how it happens, if someone want to import capital goods or raw material, then he need to apply after obtaining this letter of approval. How routinely work will happen, he will go, he will give the copy of invoice and a request, he will get a certificate, import certificate from development commissioner. On the basis of that import certificate, he will go to custom authorities, and custom authorities will clear the capital goods or raw material under notification 52 oblique 2003 without payment of duty. So one basic requirement and one confusion which is amongst industry is whether this is a custom bonded warehouse. So earlier, from a lot of years, like over a decade, export oriented units were custom bonded warehouse. But now in 2016, like we presented, we and a lot of people from industry presented that what is the need for custom control, like custom officers sitting there and everything moving or coming in with the custom control. So in 2016, from all places in FTP, in notification, the requirement of custom bonding was removed, and now export-oriented units are not custom bond. Now anything coming in or going out is not required to be approved by the custom officer. One need to maintain accounts only. So if one has taken a approval and routine import process is there, then uh, here also one need to export, and exports should be that much that the NFE is positive. Like the foreign exchange earned from export should be more than the outflow of foreign exchange from import. So one can export any kind of goods which it is doing, what it is manufacturing. Other than prohibited goods, any goods can be exported. But if someone is exporting any goods which is covered under SCOMET list, then then one need to take license from the DGFT. Uh, One can also export promotional material up to 1.5 times of the goods, and to the same consigner 5% of the value of the goods. If someone is manufacturing spares, those can also be used for fulfilling the export obligation. Uh, Again, here also under this scheme, one can import goods, all kind of capital goods. So there is in 52/2003 notification, there is a big list, but practically it covers most of the capital goods required for running any plant. So those can be imported without payment of duty. One can also procure goods from domestic tariff area, and as it will be a EOU scheme, the topic which we are going to cover next week, which is deemed export. So any GST supply to EOU unit that is called deemed export, on that also no GST is levied. So one need not to pay GST, either the supplier or after taking a certificate from supplier, the buyer, which is the EOU unit, they can get refund of GST paid. Uh, so, as I was mentioning, what can be imported or domestically procured? So, any capital goods or raw material can be imported under this scheme. So, Aditya, how much time we have? I can take I'll take 10 minutes more.
No issues, sir. No issues.
Fine. So all raw material can be imported. The capital goods can be imported under the scheme. Any spares are required to be imported under the scheme can be imported without payment of duty. So one need to go to development commissioner, justify that these goods are required for manufacture of the product which he is undertaking. So after approval from development commissioner, one can import practically any goods. So as I mentioned, NFE positive is one of the requirement. Here also one need to be careful, and there have been units, though the people established EO unit on the presumption that they are able to import all capital goods without payment of duty. Like if someone is spending 1,000 crore rupees, he will save 100 crore rupees of duty. They establish the complete. So there are instances under misguidance, people planning to supply in domestic markets took licenses under EOU and they got stuck. They have paid duty, interest, penalties. So there are like big companies doing mistake of this kind. They were having some plans of export but not able to do export. So for this scheme also one should go only if there is export. All these schemes are export oriented scheme. If someone is not doing export and someone has not done the sanctity check, what will be the NFE in 5 year he is going to export and receive foreign exchange. If that calculation is not done, then one can stuck. So here also after 5 year, while there is every year the development commissioner will keep an eye and there are requirement to file application. Uh, but after 5 year, one need to, when someone will go for like extension of license or for closure, if someone is closing the unit at that point in time, or every 5 year, one need to show that they have achieved the NFE positive. So here also, as in EPCG scheme, some domestic supplies, because Indian government doesn't want that only export should be allowed, and some there could be instances where we are supplying to EOU, he in turn is supplying to other EOU. So that can be equally counted for fulfillment of export obligation. So specific instances are there that supplies to advanced authorization holder. So there is an objective. If I am supplying to advanced authorization holder, he will do because advanced authorization holder will do some manufacturing and ultimately he is going to export. So those can be considered equivalent to export and those will be considered as a NFE positive. So if someone is supplying to advanced authorization holder, if someone is supplying to DTA unit again for against foreign exchange, if supplies to EOU unit, other EOU unit, or SEZ unit, supply of ITA bound items, supply to bonded warehouse, or supply to DTA units for export with specific controls. So those can also be calculated towards NFE positive. So few other topics are there like subcontracting to DTA, because once someone manufactures, like as I mentioned, the Korean company in Noida, when they do mobile manufacturing, lot of work, they were also supposed to get it done from other small vendors, small domestic areas. So those provisions are there that if someone want to, after importing, want to get some job work done, some painting, some low end works are required to be done. So that can be done. One can subcontract part of it processed in domestic tariff area, provided he receives the processed goods back into the EOU unit. Uh, the same way, there is a limit, but like up to 50% of the total processes, total value addition done in India, that can be subcontracted. The same way, the job work, etc. If EOU want to do job work for others, then that can also be done, because under EOU manufacturing is allowed. One can do the service part also. So job work also is allowed. For the fourth point, I'm on fourth point. If someone want to send the capital goods for doing the job work, because in case of MNCs, specific kind of capital goods are required even for doing the job work. While the process is low end, but the specified capital goods are required, specific tool jigs are required. So those can also be sent back to the job worker. But again, there need to be proper record and need to be received back. Subcontract to other EOUs can also be done, and if some scrap is generated at the job worker, so either that should come back or that should be cleared on payment of duty. So this job worker was one of the issue which I was mentioning under custom bonded warehouse manufacturing scheme, because time by time schemes get mature. So in that scheme also, all these provisions which we have discussed, those have been incorporated by the way of clarification in custom bonded warehouse manufacturing scheme also. Earlier, this was one of the aspect, because when practically one does business, he need clarity on all these points, and those have been included in the custom bonded warehouse scheme also by the way of circular a couple of days back. Rejects, I have clarified that one can clear on payment of applicable duty, one can clear the rejects. So one important aspect is there which companies face is the capital goods. The capital goods which one is having, if after some point in time the capital goods will become redundant or they will become scrap. So one, because as I mentioned, everything is subject to actual user condition. If someone moves from EOU unit, he need to pay the applicable duty. But under EOU scheme, in notification 52/2003, there are depreciation rates given. Whatever one is using for ROC purposes or income tax purposes, those will not apply. The rates given in the notification 52/2003, those notification will apply, which like for first year 10% for each quarter. So computer item in 5 year will become zero, and other item in 10 year will become zero. So one can take benefit of these schemes, and if the capital goods are moved out from the EOU unit, one need to pay the duty on the depreciated value. So we have seen instances wherein people clear the capital goods and they don't take proper approvals, etc., from the development commissioner and intimate to CBIC. For one of my client, they used it for EOU purpose. After 10 year, some of the equipment without proper maintaining the accounts and taking approval, they cleared. And then later on, when they want to exit from EOU, then they were not having any record. They have only like their accounting that these has been sold as scrap, but they have not taken approval from the government, and they have to pay like 6-8 crore rupees of duty. So if the complete process is not followed, then at a later point in time, at the time of closure of the EOU unit, because every unit one fine day has to be closed. So at the time of closure, they will verify from the day one, like if some unit is a 10-year or 15-year old unit, they will verify each single capital goods imported under the scheme, whether that has been properly after approval disposed. If not disposed, you need to pay duty. So the exit procedure we have covered, because EOU and STPI, these are a fading framework. People are getting, if you meet any EOU, this could be one of the opportunity for any practicing CA, if you know any EOU, because after 10 year there is no benefit of keeping under the having the custom control. The income tax benefit was taken away in 2012 itself. Now the if the capital goods have become like zero depreciated, then one can easily come out of the scheme. So for coming out of the scheme, one first need to apply in the required form to a development commissioner. He will give a in principle approval. This is very easy. One can apply and get the approval. He will only check that all the returns, etc., have been filed. After that, the custom authorities will come into the play, and they will verify from day one whether every material is there or disposed of or not, and they will do if any applicable custom duty is required to be paid on depreciated value. So one need to pay that duty, and after that, again a final approval will be given by the development commissioner, and there are some green cards, etc. Those are cancelled by that office. So under the Chapter 6 itself, STPI scheme is also governed, which is similar to EOU scheme. If someone reads Chapter 6 of FTP or a handbook of procedure, it will completely read about EOU. But the STPI is also governed by this chapter, this scheme, this notification only. So it also has the same objective: export of services, any capital goods required for provision of the services can be imported in STPI. Again, in 5 year, one need to be NFE positive. So again, if someone is having STPI unit, again I am saying, if for EOUs and STPI, this could be one product. Even we are trying with all STPIs and EOUs that now you should go out of these schemes, because the income tax benefit was withdrawn, heavy compliance cost. One need to do APR, monthly, annual, soft tax form filing in STPI, and same in EOU. The benefit is only of EOU. GST anyway is creditable, or one can get refund. And if old units, then the depreciated value of the capital goods have also become lesser. So it's good to become a DTA unit. Better to become a DTA unit. So if we see the trend, also every year around 300 to 500 STPI units are exiting. So because the reason is, if someone is doing any services, if someone is in STPI, then he is not eligible for SCIS benefit. So for one of our client, we calculated the duty payment was coming 2 crore and the benefit was coming 8 crore. If they were exiting on depreciated value, they have to pay 2 crore of duty, but they will get SCIS of 8 crore. So that could be the benefit, and people don't even think they are continuing with the STPI unit. There is no income tax benefit. uh, uh, if some established software technology parks units are going on, now they are not going to import huge value of capital goods, computers, etc. So this is one of the good opportunity. In any case, government is also working towards changing all these units from EOU or STPI scheme to custom bonded warehouse manufacturing scheme. So I'll take 2-3 more minutes, and so I'll just explain like benefit of the various schemes, comparison of various schemes. So anyone doing a business in India can have following option. He can have a SEZ unit. He can have a EPCG plus advanced authorization. EPCG, he can import capital goods. Advanced authorization, he can import raw material. So again, the work done, the manufacturing plant can be used. EOU, again, capital goods plus raw material can be used, and inbound manufacturing scheme. So income tax In SEZ, the sunset clause in on 30 was till 30th June. I'm not sure whether this has been extended for 3-4 more months or not. But now the income tax benefit is not there. If some new business is starting, income tax benefit under SEZ is not there. Under other three options of running a plant, in any case, the income tax is not there. So this is same for all. The BCD and IGST on import of goods. In case of SEZ, there is a upfront exemption. In case of EPCG and advanced authorization, also upfront exemption, but GST is till 31st of March, and this scheme itself is till 31st of March. So if someone comes for a long-term planning, this may not be suggested. The same is with EOU. Here also upfront exemption, but the life is small. In case of inbound manufacturing, upfront exemption, long life. IGST on import of services. In case of SEZ, it's exempt. In other cases, like one need to pay and take set off or take refund. Location SEZ, there is a foundation. You need to go in SEZ office only wherever the SEZ is located. The other three schemes one can use anywhere in India. Wherever you want to open a factory, you can use this. Compliance requirement SEZ, there are simple basic QPR APR to be filed. In case of EPCG and advanced authorization, one need to take lot of advanced authorization for raw material, for your monthly, quarterly requirement or a DFIA, and take EPCG license, get EODC, get debited in customs, etc., etc. Same in case of EOU also, you need to file MPR, APR, lot of compliance need to be done. In case of inbound manufacturing, once you need to take a approval, after that just maintain accounts. Export obligation, uh, in case of SEZ, there is a export obligation because one need to be NFE positive. In other two schemes, because these schemes per se are advanced authorization and EPCG, one, as I was explaining, one need to for sure do export. Otherwise, how he will fulfill the export obligation under EPCG scheme? In case of EOU, also one need to be NFE positive. Under new scheme, no NFE positive, you do 5% export, 95% domestic. That is workable. Controlling authority, SEZ and custom. In case of SEZ, in EOU and DGFT, it will be customs, DGFT, and GST authorities. In case of new schemes, no DGFT, only customs and GST authorities. So domestic procurement, in case of SEZ is zero duty, upfront no payment of duty, but in other schemes one need to pay and get refund or can take credit. DTA clearance of goods, one need to pay BCD on finished goods and IGST on finished goods. In case of advanced authorization and EPCG, again, these are for export, not for domestic supply. In case of EOU, one need to pay whatever have been the duty foregone on raw material used for finished goods, that need to be paid, and GST on the finished goods need to be paid. In case of CBW, also the duties on raw materials and GST on finished goods need to be paid. So infrastructure cost, if someone takes on rent like the premises, then in case of SEZ it's lesser because SEZ developer gets a lot of benefit. So if someone is going to take a unit in SEZ, if someone takes, then the rent could be 200 per square feet. If it is a normal area, in SEZ it could be 100 rupees square feet. In normal area it could be 200 square feet, because SEZ developer would have obtained a lot of benefit. So infrastructure cost in case of SEZ is lesser, but from long-term perspective, WTO complied the first the three option EPCG, EOU, advanced authorization, SEZ. All these are challenged by US, and there is a ruling against us. And this CBW is WTO compliant. So just if someone want to do a good reading about the EOU scheme or these schemes, then for SEZ and EOU, uh, there is one famous publication through few IRS officers, so that can be used. ICWI also issued scheme, which is a booklet which is easily available, and it's good for reading. If someone want to read the book and understand these schemes in greater detail, then that is available like on WhatsApp also. It's available in public domain, so that book can be used. or DGFT side. So that's all. I have increased the time. Apologies for that. Uh, but if there is any question, I'll be happy to answer.
Yes, sir. Thank you so much, sir. Thank you so much. So, sir, yes, sir. Moving on to the questions. We have one question from Venkatesh. He's asking that what schemes are available to service sectors, like similar to manufacturing under custom bond? So he wants to know the futuristic option available.
We are in discussion with government that the CBW scheme should be allowed for service sector also. So presently, only the present like STPI etc. that is available, which doesn't have a long future. But CBW, we are like advocating for that. Like day before yesterday, they have allowed the job work, that job work can be done in custom bonded warehouse. So job work can be in the nature of service. So we are in discussion with that. So presently, custom bonded warehouse scheme, the as it reads, is only for manufacture and other operations. But long term advocacy is going on. So we hope the services will also be covered in CBW. But as of
Okay.
now, it's only STPI scheme.
Okay. Thank you, sir. So, sir, inbound manufacturing is the future. Sooner or later, we would be there. We have to take up that scheme.
Yeah, for manufacturing, to even like
It,
we have drafted provisions and given to CBEC that you need to make these changes, but two ministries are involved. If only CBEC would have there, they would have made the change because changes in FTP are also required. That if someone moves from EOU to CBW, then presently one need to pay duty. So those changes we have suggested, but in few months it will happen. We have even started talking to all existing EOUs that this is going to happen.
yes, sir. Okay. And sir, one more thing. Sir, you have mentioned that SEZ in India hasn't been that successful as compared to other countries. So what could be the main or just main reason for that? That why hasn't it been that successful?
As I was telling, like we have spoken to a lot of companies. The main reason is the complete infrastructure. This because India is like 1.3 billion people. So if someone is having a plant in India and the scheme is such that you manufacture and export out of India, if you will manufacture in India in SEZ and supply to domestic tariff area for 1.3 billion people, then you have to pay basic custom duty. There is no benefit. That is why this has not become a big success in India, because the capacity of plant, like
Yes, yes.
if you ask me, Toyota's capacity of plants in Japan is such that they can supply to whole world using those plants. So if someone establishes a plant in India, then he will for sure want to manufacture in India and supply in other countries. And how can he leave these 1.3 billion people? So and if that is de-incentivized, that will not become a success.
So thus come the inborn manufacturing, which is
Yeah, that has come. In
approaching, yeah.
inbound manufacturing, one of the big hurdle is like they, as I mentioned, in EOU scheme, they have mentioned that there will be a depreciation.
Yeah,
So,
yes, sir.
but in custom bonded warehouse scheme, they have not mentioned that there at after 20 year there will be a depreciation. So after 20-25 year, one need to scrap the plant. Like new plant is established, it will have a life of 20-25 year. But what after that? That after 10 year it should become zero because there will be burden. Okay, after 20 year I need to pay duty. So that depreciation norms has not been given. We have represented time and again that should be given, because the government in one of the FAQ to Invest India, they clarified you can export the scrap plant, you can export, then there will be no duty, but that practically is not possible. So that is
Yes.
one big hurdle in that scheme people are not adopting.
Okay, sir. Thank you, sir. And sir, one more question is there. In such tough times right now, everyone is facing. What do you think? How better India will cope up with its foreign trade or with these schemes? What do you see? How India's capability? I would like to know. We would like to know.
So lot of capability is there. Only thing is, what the part Indian government misses is like they don't give a complete perspective. Like the holistic view is not given. Some bits and pieces things are done. That is a challenge. But other than that, Indian government, at least this government, is very open. They are taking suggestions from industry, and like this, as I mentioned, the faceless assessment and Karutar provisions have come. So it is a nightmare for importers. But on the same time, the government is very open. They are hearing a lot of things are coming. So I see a lot of potential in international trade and this trade facilitation agreement, because like as I mentioned, India has adopted. So that will reduce the international trade cost by 14% as per World Bank report, because the tariffs can't be reduced. But if the operations can be faster, then that itself will reduce 30% the international trade cost.
Okay,
So
sir.
which India is doing, and you would have seen the ease of doing business rating and the international trade rating that has come really well for India.
Yeah, that is why I asked the capability, because that is what we should focus on rather than just thinking about the negative aspects. Okay, so moving on. So thank you so much for providing such great information and insights on EOUs and EPCGs. I'm sure all our viewers and all our attendees would definitely benefit from this and would be more positive towards India. So that is what we wanted to know, a positive outlook. And thank you so much, sir. Thank you so much for
Thank
your
you.
time. It was
Thank you.
really nice to have you.
For your time, sir.
Thank you. Thank you.
And we will be continuing our FTP series tomorrow as well, where CA Shuchi Agarwal would come and would speak on the deemed exports. Would you like to add anything, Aditya?
So thank you, Vimal sir, and to all the viewers who are right now watching on YouTube and Facebook. We would request you to please subscribe our channel, YouTube channel, and like our page for getting regular updates related to our profession and what's all going on the financial and economic world. So thank you all, and thank you for being so patient in hearing sir's session. So signing off. Thank you again, Vimal sir.
Thank you.
Thank you so much.
Thank
Thank
you.
you,
Thank you
Thank
Shivangi.
so
you.
much, sir.
Thank you,
Thank you,
Shivangi.
everyone.
Bye bye, sir.
Thank you, Aditya. Thank you.